Hi everyone, good morning. So, all right, let's begin with the meaning of free cash flow. Today we are going to start with free cash flows, free cash flow to the firm. Just give me a moment. Let me just go to the free cash flow slides. Okay. So today we are going to start with free cash flow, and this is actually important. Previously we have discussed free cash flow to the firm, and today we are going to start with. Previously we have discussed free cash flow, and now we are going to start with free cash flow to the firm. So let's start. So the basic definition of free cash flow, what free cash flow refers to is the cash flow generation by a company that is available to all capital providers. All capital providers, I'm emphasizing on available to all capital providers here, providers of the capital. And understand that this means that both equity holders and debt holders, and after the firm has paid its operating expenses, taxes, and made the required investment in fixed assets and working capital. All the free cash flow that is available to the capital providers of the company or the organization. Now notice the phrase I'm emphasizing on available to all the capital providers here. This is very important. Free cash flow does not belong only to the shareholders, it belongs to everyone who has invested money in the firm, including lenders. In simple words, free cash flow to the firm measures the true operating cash surplus of a business before financing decisions are applied. So we are asking a very basic question here. How much cash does the business generate from its core operations? From its core operations. Think about free cash flow to the firm as the cash produced by the business. If the firm has no debt and no dividends to worry about, and that is why free cash flow to the firm is so powerful, and it's used in valuations, and it's very frequently used in valuations. Okay, let's move to the next topic, the importance of free cash flow. So the okay, once more, I would like to emphasize, I would like to revisit this thing. Free cash flow, it's available to all providers of capital. Just remember this thing. There are only two names, there are only two terms, free cash flow to the firm and free cash flow to the equity. So if we are talking about equity, it's pretty much understood that we are talking about only the equity component, not the debt component. So never get confused. And when we are talking about free cash flow to the firm, in the firm, it includes the equity as well as the debt. And this is practically the basic definition of free cash flow. The importance of free cash flow, now understand why free cash flow to the firm is important. So first, free cash flow reflects the actual cash generation. So it actually reflects the actual cash generation. uh, Accounting profits include non-cash expenses also, like depreciation, amortization, and other provisions. But cash, however, is real, and cash pays salaries, loans, and dividends. So actual cash generation is here. The second point here is that free cash flow is independent of capital structure. It's independent of capital structure. Uh, Whether a firm is financed by debt, equity, or both, free cash flow remains unaffected. This allows us to compare firms fairly, even if one firm has high debt and other has none. So making it ideal for valuing firms with different leverage levels. The third point here is that free cash flow is the foundation of DCF valuation, discounted cash flow. And whenever you hear valuations, mergers and acquisition, or or investment banking, free cash flow is at the center. Free cash flow to the firm. So if you are appearing for an interview, or uh, if you are actually doing valuations on day-to-day basis, this is the very first question. Uh, when interviewers ask you what is the formula for free cash flow to the firm, free cash flow to the equity, what do you understand by free cash flow? And you cannot uh, forget this formula, because this is actually the core and the foundation of valuation. That's why this understanding this thing thoroughly is very important in detail, and you should be crystal clear about it. Okay. The fourth point, and finally, free cash flow allows firm-wide valuation, not just equity valuation. And this is crucial when valuing entire businesses, not just shares. So in free cash flow to the firm, we are valuing the entire business, not just equity of the business, which is through the shares. I hope this much is clear. We will be able to grasp better these concepts when we start applying these in our valuation series. So, okay. So these are the key concepts which you should know in future also, if you forget, if you get confused when you are valuing. So I have made topic wise videos for this concept. Topic wise episodes are there, so you can visit these videos, and you can brush up on your facts one more time. Okay. So free cash flow versus other financial measures. When we talk about free cash flow and other versus other kind of, financial measures, so let's compare free cash flow with other commonly used financial measures. So for one measure is net income, and net income actually focuses on accounting profit available to only shareholders. So net income is actually the accounting profit available to only shareholders. So we are focusing here on accounting profit out to the shareholder. Cash flow from operations shows cash generated from operations, but it actually still reflects financing structure. When we talk about free cash flow to equity, so it shows cash available only to the equity holders. And when we talk about free cash flow to the firm, uh, it shows cash available to both debt and the equity holders. The key distinction here is that free cash flow values the entire firm, also called as enterprise value, and free cash flow to equity only values equity, and it's actually in the name. So I hope that you do not get confused onto this. Okay, so now we are going to discuss about the formula part. What are the components of free cash flow? So let's break it down, the components of free cash flow step by step. So the first component of free cash flow is revenue. So revenue is where everything starts. It represents total sales generated by the firm during a period. And no revenue means no free cash flow. Understand this thing. No revenue means no free cash flow. And that is why, if you remember previously, when in the free cash flow series, there was a difference. But there was when we are comparing the startups versus large companies. So the cash flows are negative. So the valuation of startups is done in a different way. Just understand, no revenue means no cash, no free cash flow to the firm. FCF. The second component of free cash flow is operating costs. And operating costs include expenses like cost of goods sold, salaries, administrative expenses, and selling expenses. So these are the costs required to run the business daily. The third component is EBIT, earnings before interest and taxes. EBIT is the operating profit before interest and taxes. This is critical because interest depends on financing decisions, and we want free cash flow to the firm to remain neutral. So EBIT shows a pure operating performance. When we talk and the fifth component here, the fourth component here is taxes. So taxes and free cash flows are calculated on EBIT. And why? Okay. So the the answer to the why is that because interest is ignored. So tax saving from interests are also ignored. The fifth component here is depreciation and amortization, and depreciation actually reduces the accounting profit, but does not reduce the cash. So we always add it back and think of depreciation as a paper expense, not as a cash expense, because this money, the depreciation and amortization, this money never, this actually never leaves the firm in the first place. This money, the non-cash expenses. When we talk about non-cash expenses, this money never leaves the firm or organization. So non-cash expenses actually never leave the organization. The next component is capital expenditure, and capital expenditure is the money spent on machinery, buildings, equipments, and technology. This is real cash outflow and must be deducted. So think about it from the perspective of free cash flow. When we talked about free cash flow in the previous section, previous lecture, FCF, the net free cash flow is the inflow and we subtract the outflow. So you should be at least able to identify the elements which are representing inflow and the elements which are representing outflow, the listings, the line items. So capital expenditure is actually an outflow. Okay. The next component here is net working capital. The basic definition of net working capital is that it's the current assets, we subtract the current liabilities, and an increase in net working capital means that it is using cash, and a decrease in net working capital means it is releasing cash. So since we are talking about net working capital, let's uh, talk a little more about it. So net working capital. So to run a business, we will be needing some money every now and then. So current assets We subtract current liabilities. The basic definition is current assets, we subtract current liabilities. Okay. And how now let's look at the standard free cash flow to the free cash flow to the firm formula. The most widely used free cash flow to the firm formula is actually derived from EBIT. And the formula is we start from EBIT, we multiply it with 1 minus tax rate. We add back depreciation. We subtract capital expenditure, CapEx, and we subtract, okay, let me just do a different color. We subtract capital expenditure and we subtract changes in net working capital. Let me explain this thing. Uh, EBIT, when we multiply it with tax rate, this gives us after tax operating income. Depreciation is added back because it's a non-cash expense. Depreciation, amortization, all the non-cash expenses are added back. This is non-cash expense because this money actually never left the firm. This was always with us. And we are talking about free cash flow, not about accounting, not from the perspective of accounting, but well, from the perspective of cash flow movement. So depreciation, the all the money, the amount from depreciation actually never left the firm. So this is a non-cash expense. And when we talk about capital expenditure and increase or decrease in working capital. So capital expenditure and increase in working capital are deducted because they consume cash. So this is actually a cash outflow. I do not have any more options. Okay, I do actually. So this actually is a cash outflow. And this is the most preferred value method of valuation, the free cash flow calculation. They start with EBIT, then they subtract the 1 minus tax rate, which gives us the after tax operating income. Then we add back the non-cash expenses. Then we subtract the capital expenditure and we subtract the changes in working capital. So changes in working capital, if it's increasing, the changes in working capital are increased. So this is going to be a positive number. If the changes in working capital are negative in nature, so they are going to actually add back. This is going to convert. Negative, negative comes to be positive. This means if the changes in net working capital is negative, this means we have actually consumed less cash. We have rather than consuming cash. In this case, we are consuming cash. We are not consuming cash. So we are actually saving cash if the network changes in net working capital are negative in nature. So that's little mathematical tricky, I think now. It's confusing also. So when we will practice the questions, we will be able to relate more to these calculations. Okay. I hope this much is clear and this much made sense. Now, let's talk about the free cash flow calculation from net income. So, at times, it's difficult to calculate EBIT numbers uh, because when we look at the US GAAP financials, so they do not have that. They do not report out EBIT numbers. Not every company reports out EBIT numbers, and depreciation and amortization numbers are actually clubbed in their revenue and the expenses numbers. So it's difficult to standardize the format. But if you're able to standardize the format, then the formula to calculate free cash flow to the firm from EBIT is better. But no worries. But if the company has not reported EBIT numbers, and you do not have that much time to calculate the EBIT numbers. So standardize the companies, standardize the financials of the organization and the peer organizations also. That's how it's going to make sense only, because then only you will be able to compare. So you cannot compare one different metric for one company, and compare the another company at a different metric. So you need to uh, compare across similar metrics. Okay, that's been said. Let's talk about free cash flow calculation from net income. So free cash flow can also be calculated starting from net income. So the formula here is the formula starts from net income. We add back interest expense, and yet again we multiply it with the tax rate. We add back depreciation, we subtract capital expenditure, and changes in net working capital, uh, which are outflow, which represents cash outflow. So that's why we are actually subtracting these numbers. Okay, why do we add back interest expense here, interest here? And the logic behind the adjustment is that because net income is after interest. Okay, let me just do a quick income statement format. So income statement starts from revenue. We subtract the cost of goods sold, and this gives us gross profit. After the gross profit, we subtract other expenses, SG&A, admin expenses, salaries, rent, etc. This gives us our EBITDA number. So we have subtracted all the expenses, this much, till this point. Now the depreciation and amortization comes. So we subtract the depreciation and amortization. Depreciation and amortization means when we are depreciating something, an asset. So this means we are allocating a certain amount. Uh, because every asset actually has a life. When the asset expires, we will still be needing we actually will be needing a replacement of that asset. So we are allocating certain funds, and this money actually never leaves the organization. So this is actually, you can say that this is a provision. After depreciation and amortization, we reach out to EBIT. And when we subtract interest and taxes, we get our net income. The logic here is that we have already subtracted interest income here in the previous, in this step, we have actually subtracted the interest part. And it is logical when we are starting from net income. So we actually have to reach out to EBIT numbers. So what we will do is we will add back interest income, and that's why the formula here, we actually have interest expense. We have added back the interest expense. And Because net income is after interest and free cash flow should be before financing. So this method is useful when EBIT is not directly available. So if you compare these two formulas, depreciation, amortization, and capital expenditures are here. But this EBIT into minus tax rate is replaced by net income, and net income plus interest into 1 minus tax rate, and 1 minus tax rate is also still there. Okay, I hope this much is clear. And once you start practicing these concepts, you will be able to understand these in detail. Okay. One more formula we are going to discuss here: free cash flow calculation from revenue, which is a top-down approach. Okay. So free cash flow can also be calculated from revenue here, from revenue, from the starting of revenue. So we start from revenue. We subtract the operating cost. We subtract all the operating costs. We subtract the depreciation and amortization. And we are actually using all this. We are bypassing every step. So this is actually still going to give us, we are going to reach our EBIT numbers. So, and we multiply it with 1 minus tax rate again, then the depreciation and capital expenditure and changes in net working capital. They are pretty much similar here also. So we add back the non-cash expenses. We subtract the changes in the net working capital and the capital expenditure. So this part is only changing. Revenues, operating cost, and depreciation, and everything else is same. So I've seen students, they get confused how to calculate from revenue, how to calculate from uh, net income, how to calculate from EBIT. So just don't mug up one formula. So you should be able to understand the logic behind everything. So all the operating costs you have subtracted depreciation. Ex- So you have subtracted depreciation here. Understand this thing. But later on, you have added back depreciation. Because from depreciation, you have removed the impact of 1 minus tax rate. So you have removed the impact of tax shield. So revenues, we subtract operating costs, we subtract depreciation. This gives us EBIT. And from EBIT, to get to EBIT, you actually need to calculate, you actually need to remove depreciation first, but later on, understand this thing. This actually is tricky. You have actually removed depreciation first, and you have removed the tax component from the depreciation, the tax shield, but you have later on added the depreciation back. That's where you actually have to pay attention here. Start with revenue, subtract operating costs, subtract depreciation, apply tax rate, then add back depreciation, subtract capital expenditure and the working capital changes. And this clearly shows how this sales turns into free cash flow. This part is tricky. Just remember this thing to reach out to EBIT. And if you are able to memorize the format of income statement, this should not be a problem. Why we are discussing, why I'm making these concepts, the key concepts, because see, you might be working in some different vertical in finance and the field of finance, the domain, the finance, there are multiple verticals. There is a possibility that you are working in operations, financial operations. Maybe you are working in some other domain. The thing is that your concepts should be clear. If your concepts are not clear, you will not be able to apply them. And going back and learning and reading everything from the scratch, it doesn't make sense. And also, if you are working in valuations, so you will also be having time constraints. And I have seen valuation analyst, equity analyst, investment banking analyst, they actually only get 30 minutes to do a valuation, to do a DCF, to balance the financials of a organization. So you cannot uh, brush up on you do not have that much time, so you cannot start brushing up on your facts and start to update yourself when you get the problem. You actually have to stay updated, and when the moment arrives you should be prepared. So that's the whole uh, reason why I'm making the key concept series. Okay, so we have discussed the three types of formulas, how to calculate the free cash flow calculation from. uh, I hope this much is clear for you guys. Now, uh, let's in okay. So let's do one thing. Let's the next part we will discuss in the next series, next lecture. Thank you for attending this lecture. I'll see you in the next episode. Thank you. My name is Deepak Best. Thank you for attending.